Welcome back. The future of the Federal Reserve in focus this week. We are awaiting President Trump's pick for the next Fed chairman. It's reportedly down to moderate and current Fed Governor Jerome Powell, the more conservative Stanford economist John Taylor, and the current chair herself, Janet Yellen. Of course, that's what he told me in the interview, one-on-one interview a week ago. The president added a dramatic flair to the contest over the weekend, though, with a little teaser for the position. Watch this.
People are anxiously awaiting my decision as to who the next head of the Fed will be. I'll be announcing it sometime next week. It will be a person who hopefully will do a fantastic job. And I have somebody very specific in mind. I think everybody will be very impressed.
Joining us now to talk about it is Canaccord Genuity Chief Market Strategist, Senior Managing Director Tony Dwyer. Tony, good to see you.
Good to see you,
So we're talking about Jay Powell getting the chairman's job. What would that mean for markets if, in fact, it is Jay Powell?
Honestly, Maria, I think that this is one of those stories that just is keeping. It doesn't need to keep going. It doesn't matter.
Doesn't matter?
It doesn't matter.
Wow.
Think about it. Here's why I say this.
Tell us why.
John Taylor.
When you look back at when Ben Bernanke was appointed, and he was Helicopter Ben. He was going to drop all the money down and be super dovish. He raised rates 3 times in a row. I renamed him Submarine Ben because he didn't ease fast enough, and then he saved the world. But initially, he helped cause it by not being easy enough, even though that's his reputation. It's about the data. It's always about the data. It's sort of like...
Well, the data is looked at differently if you're John Taylor or if you're Jay Powell. You're looking at the data differently.
Absolutely. John Taylor would have us at a 3.5% federal funds rate right now.
If he in the Paul Volcker era where he could do whatever he wants, but we're in a very different kind of Fed. There's much more of a consensus building. It's much more transparent. You know, within 2 weeks of what he's saying or they're saying versus 2 months when you used to get the Fed minutes years ago.
Let me ask you this. How would the market react today if the president said it's Janet Yellen? He's re-upping Janet Yellen.
I think it would just kind of go like it's going, grinding higher, because it's really, John, I love to talk about this on TV.
Well, Powell is on the Fed, so Janet Yellen and Jay Powell have similar mentality.
Right now,
he's on the Fed now.
You know what you're getting with Janet
surprise.
Yellen. You don't really know what you're getting with Jay Powell.
Correct.
And you're saying the market's okay with that?
I think the market's okay with that. I think you might have an intraday reaction. You're not going to get a tank. You're not going to get a surge. Ultimately, as you guys know, the market correlates to the direction of earnings, and that remains positive. So all of this stuff, similar to, think of all the noise of this cycle. All the noise of this cycle and what's happened. You've grinded higher with our...
It's so interesting to me. You know, we used to talk about how fat a briefcase Alan Greenspan was carrying into his office.
Yeah.
You know, the market went up and down based on that. And you're saying it doesn't matter.
But I think that's the danger, that if you're an investor and you're dismissing who the next Fed chief's going to be, that therein lies the risk. Because you've got the $4.5 trillion balance sheet that they're going to try to begin reducing. You want to see something kill this market rally, Tony, it's going to be higher longer-term interest rates.
I see it as a sign of the next bubble coming.
That's going to happen.
What?
The point isn't that that's not going to happen. That's 100% going to happen, and this is going to end badly.
What is going to happen?
Because the rates are going to ultimately go higher on the short end. The Fed is going to invert the yield curve, which they do every single cycle.
And that's how the rally ends.
And that's how the rally ends, because you end in a recession and a shutting down of the credit market.
When is it going to end?
Awesome question. So if you use the current Fed dot plot, which is the consensus view of where short-term interest rates are going to be, the Fed will invert the curve in the third quarter of next year, assuming the 10-year note rate stays here, which should happen, because if the Fed is raising rates, that decelerates economic growth. That is a disinflationary move. That's how the Fed inverts the curve.
That's what Jeff Gundlach said. Jeff Gundlach, when he joined us a couple of weeks ago, said that he would not be surprised to see a recession in the second half of 18. But I'm like, how could you say that just because recessions typically happen every 8 years and we haven't had one in 8 years?
With that.
I don't know how you agree with what?
They invert the curve in the third quarter of next year. The mean inversion is 15 months, and the yield curve comes back to
something like that.
You're in 2020
they know this
before you go
history
into
of
recession.
the yield curve also.
What's that?
They know the history of the inverted yield curve, and they know that inflation is very low. Why are you so sure that they're going to keep raising rates in an environment where they might cause a recession and inflation is very low? Maybe
don't forget the $4.5 trillion wind down. There's that.
Well,
right. I don't think that there's anybody.
That happens very gradually.
I know, but I don't think that there's anybody walking on planet Earth, whether he or she is the next Fed chairman or not, who can tell you exactly how this is going to play out in the financial markets. Because what they did was virtually unprecedented, given how.
But we know how it's playing out in financial markets. They've been raising rates since 2014.
No, I'm talking about
all of the selling
the
comes, unwinding of
but
the
balance sheet.
They've been talking
is
for
minuscule
months
relative
about
to
the
the
balance
commercial.
sheet.
I don't.
Commercial. Okay, so if I told you at the end of 2013, our two largest treasury owners, China and Japan, we're going to actually sell our treasuries, not only not buy them, but sell them,
like
and
Russia
the Fed wasn't
to
going to be increasing the balance sheet, would you expect rates to be at 2.25%? Not a chance. Right? Because commercial banks are using the yield curve to lever up their returns. So they do short and buy long.
So you're saying they're buying treasuries when China and Japan aren't?
China and Japan sold $250 billion of treasuries. The commercial banks bought $400 billion.
Can I get to the meat and potatoes, please? How do you invest in this market? How are you allocating capital right here? We know where valuations are. We know that the economy is getting better. What do I do with my money?
Maria, I think you stay long. I think you get long. I don't think you worry. There's definitely going to be a correction here or there, the corrections are only natural, normal, and healthy until you actually get one, and then it feels like the end of the world. But I think you buy into that until you invert the curve.
Wait, I have a question. Wait, I have a question. 2.5. Do you buy the 10-year when it gets to about 2.5%? It's at 2.42 right now.
Yes.
You said yes. Okay.
And here's the reason. When the Citigroup Economic Surprise Index tanked earlier this year and it was a -50 and it looks like we were going to go into a recession globally, that's a great contrarian indicator when it gets to an extreme. It's on the other extreme. It's almost +50 now. So it's not my opinion. It's just the data. When you get expectations so high for economic activity, you want to buy treasuries and fade the growth
How about
a little
equities?
bit.
You like tech, financials? What's the word?
Maria, we're in the pro-growth sectors, which would be financials, industrials, materials, energy, and even infotech.
All right, we will leave it there. Tony, great to see you.
Great to see you.